Good morning, everybody, and thanks for coming along to join us for our webinar this morning on cash versus bonds versus equities. We've had a lot of registrations for this morning and great feedback on the theme and the topic. So hopefully you benefit from the session this morning. So I'm firstly going to just go through a few usual housekeeping bits. So you can submit questions throughout the webinar to me. There is a little Q&A button on Zoom. So please do submit questions as you go, and I'll endeavour to answer them either during the session or at the end. As you can see, this is being recorded. You're not being recorded. The webinar itself is being recorded, and we'll send out the slides and the recording afterwards, should you wish to watch it back, or if you want to pass on to one of your friends, family, or colleagues. Okay, so firstly, cash, bonds, equities. I just want to recap on each asset class because sometimes there's a bit of overlap between them. And I'm going to spend a bit more today on bonds because bonds seem to me to be the least understood of all the asset classes. So before we go into these three, when I speak to clients about options on investing and not investing, retiring and funds to be dispersed, ultimately capital has to be parked into one of 6 buckets, okay? No matter what, always has been, always will be. And I think it's a great way of just simplifying things. So the first default one, as we know, is cash, okay? Cash is the asset class we're probably most familiar with. Bonds, which we'll speak about today. Equities, and I mean here listed equities, so equities that are on a public stock market. Property, which we're all very familiar with. Private equity would be if somebody had their own business, shares in their own business, or decided to allocate capital to a private enterprise, like a company that's not listed on the stock exchange, private equity. And the last one is is alternatives, which is anything that doesn't fall into the above buckets, okay? So no matter what, your current capital, your previous capital allocation, future capital allocation is going to be in one of these 6 buckets. That's pretty much guaranteed, okay? So the choice is how to allocate the capital between them. And today we're going to focus on cash, bonds, and equities, which really are the 3 dominant asset classes for allocating capital within a portfolio. This is particularly relevant at the moment, given the way interest rates are, as we know. So let's start with cash, the easy one. So the key features with cash, as we know, it's the default asset class, okay? I mean, income is received in cash. Any income you've ever received, we don't have the barter system anymore. You receive the income in cash. If you sell an asset, somebody offers you a price of a cash and funds are transferred into your account. And if you make a payment for something, it's done in cash. So cash is the default, okay? There's negligible risk at the moment. I mean, even with the crisis in Ireland a number of years ago, cash was still safe. So technically the first 100,000 per person is guaranteed per bank. So ultimately it's seen as the safe asset class, okay? So capital that's not going to go up and down in line with markets would be cash. So I suppose there's 2 different types of rates, okay? There's overnight deposits, which is basically your current account. So overnight means you can access it today or overnight, whatever it is, so it's in a current account. And then there's fixed term deposits, and that can be 12 months, it can be 24 months sometimes, it can be 6 months. Generally, banks won't really offer term deposit rates more than 3 years. You'll see that most of them are around the 12-month mark. And you'll obviously get a better interest rate if you lock in for the 12-month period or the 6-month period, or whatever it is. So for all of us here based in Ireland, the banks available to us really are the 3 main: Bank of Ireland, AIB, and PTSB. Ulster Bank, as we know, and KBC have left the market. There's also international banks that passport into Ireland through the EU. And these are banks we don't really know the name of, but there are other options through websites and stuff to put money into. And the last one is there's investment banks that have a base in Ireland that invest your money, and they can also offer deposit rates, but they generally will only do that hand in hand with investing through them. So they're the main options on who we can use in Ireland. I think it's important to say what I don't define as cash, okay? So if somebody says, I've got X amount in dollars and it's sitting there in current account in dollars or sterling, or I've sold a business in the property in the UK, or I've sold and I've got sterling cash there. I mean, if that's a sizable amount and you're holding it long term, yes, technically it's sterling cash or dollar cash, but it's actually a risk asset because dollar and sterling can change relative to the value of euro. So I wouldn't classify that as cash in the sense of, risk versus return. Money market funds, I don't classify them as a cash equivalent either, to an extent that they are, in that they're instruments of cash instruments will populate the fund itself. But actually, with those kind of funds, the rate can change. The rate you get today could change tomorrow or the following day. So it doesn't serve the same purpose as saying, for all of us here, we want to look at cash in two ways. What's in your current account that's accessible for a charity or for a business or for whatever it might be. And secondly, cash you intentionally keep on term deposit that gives you a guaranteed rate over a finite period. Money market funds, to me, are often ways of kind of frankly investment managers extracting capital in to invest on their platform when actually there's fees and different things involved. So they're not the same as just pure cash. Government bond funds, sometimes bond funds are seen as, oh, they're guaranteed and there's a good rate of return or whatever it is, and it's safer than cash, but actually it's not the same as cash. So I wouldn't classify government bond funds as cash. And you often hear of structured products where there's a 5-year capital guarantee, and if you invest X today, in 5 years' time, 100% is capital protected, so it's akin to cash. That is definitely not the same as cash, okay? So they are ultimately equity instruments structured through a complex product, which will be more of an equity type investment. So the role of cash, as I said, it's your default for surplus cash savings. And anything that's not cash, which we talk about bonds and equities, is an investment. Okay, so best way to look at your assets, I gave you the idea of the 6 buckets earlier, but really a more binary view is you either got cash or you've got everything else. And anything that's not cash is liable to go up and down. So you should see cash as a building block. It's the first layer of any portfolio. It's the first thing to say, how much do I want to keep in cash as an emergency fund, as a diversifier? And the other 5 asset classes are the proportion to equities and bonds. It's easier to populate that once you've got your non-negotiable amount of cash first and foremost. So it can be an emergency fund, it can be a diversifier. And I'm conscious on this webinar, we've got business owners, we've got individuals, we've got charities, but it's all the same principles. You want to allocate an amount of cash, depends on the security of your income. If you're younger and you're running a big cash flow surplus and you've got a guaranteed income, your need for cash might be less because you're running a surplus the whole time. But if you're a bit older and your risk profile is lower, potentially need more cash. It depends on your, as I said, your cash flow surplus or deficit position and the value of all your other assets. So next, bonds. Okay, bonds also go by fixed income. It's also fixed interest. So ultimately, fixed income, fixed interest, bonds, it's all the same thing. So I'm just going to spend a bit of time here because when I deal with clients, generally people are always asking questions about, can you explain bonds? Because most people understand kind of what equities are and obviously what cash is, but bonds is that mix where it's kind of quite opaque in a lot of ways. So it's basically a loan from a government or a company to investors through capital markets. Okay, so it's a way of a company raising money, and rather than the chief financial officer of a company sending out an email to all his friends and family saying, look, we're looking to raise 100 million on the markets. What rate do you want? What rate do you want? It's all done through capital markets very, very efficiently. So every bond will launch on the primary market at a nominal value of, call it €1, $1, one pound sterling, whatever it is. So that's the fixed price at the start. So it's very difficult for retail investors or for most people to get access to a primary launch on the market directly themselves. It has to go through an investment firm and all that. So the bond will have a fixed term, and the issuer of the bond will confirm and agree to pay back the loan at the end of the term. So I'll give you a detailed example in a minute at the same launch price, okay? So In the period between the launch date, the primary market, and the redemption date, the bond is a tradable security. And that's great because if you did sign up to 100 grand into a bond for 10 years, you'd like the ability to sell it if your personal financial situation changes, or if your risk profile changes, or your objectives change. And that's what the secondary market does. So the secondary market is quite efficient. And I would say, yes, it launches at $1 or €1 or £1, but the following day, the price will go up and down based on a number of factors, which I'll talk about in a minute. Now, trading individual bonds is difficult, right? So for somebody who's got less than 10 million to invest in bonds, very difficult, because how do you get access to the primary market? They often trade a minimum 50,000 tranches, all that type of thing. So generally for bonds, tend to be the exception of a government bond one may buy, it's done through professional investors, who, managers like us would appoint, who we believe the best institutional investors are to invest bonds, capital on behalf of our clients into bond funds. So the types of bonds, okay, as I said, government bonds and corporate bonds. The investment options are you buy bonds directly or you buy collective bond funds. So I'd be more of a view of collective bond funds. So what impacts the price of bonds and the key factors, okay? The security of the issuer. So you're more likely it's safer to buy a German government bond than it would be to buy a bond in a company you've never heard of that's very small, that's risky, okay? Because the small company may not have the money to pay it back, but Germany most likely will, obviously. The term to maturity. So, if you buy a 20-year bond, you've got longevity risk, whereas a shorter term bond, you're going to get a lower yield, but it's more guaranteed because the term to maturity is lower. So when we invest in bond funds, you'd always look at what they call the average duration, which may be 8 years, it may be 10 years, it may be a particular type of bond fund that has a 4-year, 5 or shorter term time horizon. The coupon is obviously very important. So when it's launched the primary market, is it 2%? Is it 5%? Is it 4%, or whatever it might be? Obviously, the higher the coupon, the higher your potential return. The price of the bond. So as you know, the primary market will always launch at par, but the following day in the secondary market, the price will go up and down. And I'll give you a detailed example of that in a minute. And the yield to maturity. So this is worth explaining. So if you buy a bond day one in the primary market and it's 5 cents in the euro, you receive a 5% return. But the following day, if it goes up to 101 or down to 98, or if in a year's time it goes up to 112 or down to 70, your yield to maturity is a kind of a mathematical formula that will calculate what the coupon is. Remember, the coupon is based off the anchor of the par price, what the term to maturity is, and what the price you're paying is. So it's actually quite complex for an individual to do it on a calculator, but I'll show you again some yield to maturity examples in a minute. And the liquidity of the bond is important. If you buy a bond in a small cap company that doesn't really have a corporate broker, your spread, the cost of selling out a bond could be substantial. Whereas if you buy a bond, or professional bond fund managers who invest in multinationals, they can trade in and out of bonds very, very efficiently. That's why it's very difficult for individuals to create a bond portfolio in the same way we can invest in a retail portfolio quite an equity portfolio quite efficiently. Okay, so just on to equities. I won't spend too much time on equities because shares are the most common. People talk to me about equities all the time. I saw the price of this company is up or down, but people wouldn't come to me and say, I see that 2028 corporate bond for CRH is down by 2 basis points yesterday. So that's why equities are generally, people are more familiar with them. So they're the biggest, most liquid asset class. And they're just a great way. Equity markets for 100 years are a great way for my clients, our clients in Compass Private Wealth, you guys as investors or wherever it is, to get access to a company in a highly, highly efficient way by buying stock in that company. So one can get access to a company, a sector, or geography very efficiently through the stock market. So there's different types of companies, the size of the company, small cap, mid cap, large cap. So we know what the large caps are, the Apples, the Teslas, these kind of companies. There's obviously other smaller companies, there's different metrics for valuing what is a company, where does it become a mid cap, where does it become a large cap. But obviously, we're all more familiar with the large cap companies. Some of the bigger Irish companies that we're familiar with are actually only really mid caps or small caps in the global market sense. The geographical focus, so some companies might be listed in one country, but actually all their revenues come from a different economy. So we know there's a lot going on in Ireland at the moment where we're losing listing to the US and various places. But, someone might say Apple is a US company, but the important thing is where does it get its revenues from? Where do, the UK FTSE has a large number of big PLCs listed there for historic reasons. But just because Tesco is listed in the UK, yes, it's listed there, but 100% of the revenues don't come from the UK. So that's just important when you're looking at companies. Obviously, every company has a sector. The odd company, like thinking out loud, DCC is involved in a number of different sectors, but generally listed companies will have a sector. There's about 9 or 10 different types of sectors that they can be categorized into. Companies will vary depending on their profitability. So some companies make more money than others. Some companies pay a dividend. Some companies have a book value. There's all sorts of complex metrics that Robert and myself would have to do a separate session potentially on that, on how the financial metrics for valuing companies. And then you say, well, how do I invest in companies? And one can buy shares directly in the companies, or you go into collective funds. Simple as that. We'll talk about that in a minute. Okay, so now that we've talked about each asset class, we're going to speak about the risk, return, and market forces. So this is, look, I'm a big believer in a picture paints 1,000 words, and this isn't scientific or anything, but just to illustrate the point, okay? With cash deposits, one of the 3 asset classes we're talking about today, you're signing up for lower risk, and in place for that, you're going to get lower return. Low risk, low return in a normal environment, okay? Next level up, bonds, you're going to take a bit more risk for slightly more return, and equities, slightly more risk for slightly more return. That's the kind of simple illustration of it, okay? Now, what I've done on the next slide, which I'll go to, is I've kind of broke it down into a bit more, the exact same chart, but just a bit more detail, okay? So the first one here is current accounts, okay? So current accounts, you're basically getting in Ireland at the moment, you're getting no return whatsoever for, there's always going to be some risk, okay? Even if you put cash under your mattress, there's risk that you get burgled, whatever it is. So there's always a level of risk that we have to put up the white graph, the white line varies so slightly, okay? So no return for slight risk. Then you can actually get good rates at the moment on fixed term in Irish banks, okay? So what I've done here is I've illustrated by saying, okay, you can get like 2.5% to 3% return and ever so slightly more risk because you are locking into that institution for a period. Next one then is government bonds, okay? So you can get a decent return out from government bond funds all of a sudden at quite negligible risk. Like government bonds aren't really going to default on investors as such. Next level up then is corporate bonds. So you're going to get a higher return from a corporate bond than you are from a government bond, purely because market forces will say, well, there's a higher risk of a company defaulting than a government. Now, again, we could get way more complex into this because some companies will be lower risk than some governments, obviously, like a perceived high-risk government issuing a bond will have to pay a higher coupon rate than a safe company as such. And then you get into the other end of it, you get like high yield bonds where you get speculative companies who are maybe an oil and gas exploration type company and they're raising money. And investors would say, or professional bond fund managers will say, well, no problem, I'll invest in your bond or I'll lend you the money, but I want a return of 12% because the risk is a lot higher than, further up in the corporate structure, which I'll show you a slide on that in a minute. Then when you look at equities, there's all sorts of different types of companies, as you know, obviously less established company in a risky environment with a risky product and revenue offering is going to be higher risk, higher return than a more stable type of company that pays dividends every year and that type of thing. But just 2 different ways of looking at it is, one is, collective equities. So if you invest in equities, but you go into a fund, you're going to get equity return participation without huge risk, because if you invest in 100 companies or 1,000 companies in the fund, okay, a couple of them might go to zero or go bust or hugely underperform, but it's not going to impact your overall net asset value. So you're reducing your return by maintaining risk. And then direct equities, I suppose you're kind of getting the same level of return, but you're taking on significant risk. So look, this isn't scientific, it's just to illustrate only what the type of risk return characteristics are. And this is useful just to show you like a sample, again, not scientific, bank balance sheet. Okay, so if you were to invest in a bank, okay, the purpose of today's webinar is cash, bonds, equity. So in the bank balance sheet, you can invest in all three. Okay, so by giving a bank money to place on deposit, you're up the very top of the capital structure. So you're the safest. So everything below you would have to go bust before depositors will be impacted. Then below that, corporate bonds, tier 1 bonds, tier 2 bonds, all sorts of different types of bonds. But that next layer of the cake, I suppose it's kind of like a high-rise building, you know, of risk of flooding. The depositors, if it's 30 stories high, the depositors are at the very, very top. And then the next layer down will be the different tranches and tiers of bonds. And at the bottom then is the equity. So it's just a graphical way of saying, if things go wrong, equity investors will be impacted first, generally, followed by bonds, followed by, and that's why you're going to be rewarded in terms of return more for equities, then bonds, then cash. So the higher the risk, the lower down the capital structure. So now I'm just going to speak about market forces. So hopefully you're saying, okay, well, what impacts the rate that I'm going to get on cash and bonds and equities, okay? So the main thing, as you all know at the moment, is what the central bank base interest rates are. So we're members of the Euro, the ECB, the governing body. So the rate that the ECB sets will ultimately govern indirectly what the banks in Ireland offer as deposit rates for us, okay? And where does the ECB central bank rates come from? It comes from inflation. High inflation, higher interest rates, and therefore better deposit rates available. So remember that what a bank don't want, a central bank don't want, is they don't want inflation for too long. So how do they curb inflation? They raise interest rates. What are they trying to achieve? And they do that. They're trying to reward savers by giving you better deposit rates and punish borrowers by making it more expensive to borrow money. That cools the economy. More people put money on deposit than speculating. Higher inflation, higher interest rates, higher available deposit rates, okay? Competition within the banking sector makes a big difference. In Ireland, there's very little competition. So what happened last year, a lot of you, our clients, knew Irish banks are very slow passing on deposit rates to borrowers. And ultimately, the media, frankly, got hold of this. They were saying, well, a German bank is giving 3%, an Irish bank is giving 0%. So there was political pressure came on to pass on rates. So the reason why Ireland actually increased interest rates, it's not really competition. Frankly, the banks aren't really looking for deposits that much. It was actually a bit of political pressure to say, come on, pass these rates on. And obviously company specific as well. So like, you know, we have to be mindful of different banks and different strategies as well. So next one, I want to just talk about a bond. So rather than speak about what affects a bond price, I'm just going to speak about a specific example, okay? So let's say a company launch a 10-year bond paying a 5% coupon. Remember that launched at the price of €1. And let's say this is a European company. And at the time, base rates in Europe are 2%. So if base rates are 2%, you expect to get maybe 2.5% on deposit. So you say, okay, a fund manager would say, well, I can put this money on, buy this bond for 10 years. I can get a coupon of 5% per annum. That's better than the 2.5% that's available on deposit. And this is how investment markets work. So, okay, I'll buy that 10-year bond. And it's great because it's a liquid bond. It's a big multinational. So once it's launched in the primary market, I'll be able to buy and sell as much as I want at different times. So that's an attractive rate. Now, let's say that in this case, central banks increase the base rate from 2% to 4%, okay? Professional investors then, or investors, advisors like us, would say, well, 5% was great when the base rate was 2%, but now the base rate is 4% and I can get 4.5% on deposit. So that 5% coupon that I'm kind of getting from the initial launch isn't as attractive. And the bond markets value that as a factor. So they will say, oh, well, it's no longer going to be at euro. The value of that bond will drop to, say, 90 cents, for example, or it'll drop to below par. So a new investor coming in 2 years after launch would say, oh, XYZ Limited, they launched a bond 2 years ago. There's only 8 years left in it. Actually launched a euro. I can buy it at 85 cents now. And based on the 5-cent coupon at a euro, the yield to maturity is 6 or 7% or whatever it might be. But it's all relative because the yield to maturity is all based on what base interest rates are. Okay, so the opposite then, let's say, for example, inflation dropped, interest rates fell to zero. Then what often would happen is this bond would go up to 110. So new investors will be buying the bond at a rate not of 5%, but a yield to maturity of 4% or less. But again, if that rate yield to maturity is 3.5%, that's still good because interest rates are at zero and the deposit rate available might only be 0.5%, whatever it is. So that's why interest rates are so important for bond markets. And remember, the more secure the issuer, the less the coupon they have to pay. So oftentimes, like if something happens to the company or the government during the term, that's another factor that would impact the price of it. So no matter what happens with interest rates, if people are worried that the company is in trouble, the bond price could go to zero or could go all the way down. That's why bonds aren't risk-free. Won't spend too much time on equities because it's something we're most familiar with, but with equities, their annual profits is obviously the big factor to determine the value of it, and the price earnings ratio, so what the multiple is, and what their dividend yield is. So sometimes companies don't pay dividend, but they accumulate their profits back up within to invest it. That's kind of like a growth type company. But dividend yield is important to value a company, whether it's growing or not. So whether it's a dinosaur company that's losing market share, that would obviously be a riskier investment, and there'd be a kind of a better value buying it because your the price earnings ratio is more favorable, but that's because the future earnings are dropping as such. How the company is performing generally. So a lot of people feel as though they invest in shares themselves and they're kind of based on a gut feeling or a couple of websites they did a bit of research on, but obviously the more sophisticated approach is to use professional managers or investment advisors like us who appoint professional investors or just buy equities on a passive basis. So things can change for the landscape of the company. So what the sector, the geography, the economic environment might change. General market sentiment. We've had a very strong Q1 for 2024 and a good Q3, but actually April has started quite negatively. So that's also a factor. So if the market sentiment is negative, share prices will drop. And there's lots of other factors that will impact on the share price of a company. So investing in shares or bonds, you can go collective into a fund, active management. Generally for bonds, you have to kind of go active. There's some passive bond funds, but generally because of so many redemptions and playing with the maturity and buying and selling bonds, you kind of have to go into an active fund. Passive funds for equities and active funds for equities, and also one can buy individual shares and bonds as well. So briefly on the tax treatment of these investments. So there's a lot of people here who have money invested in charities or pensions. You don't have to worry about tax. There is no tax implications within those, but for everybody else, the rate of deposit interest retention tax, DIRT, is 33% plus PRSI of 4%. On post-state savings are tax-free. So there's no tax on Irish government bonds. If you invest in individual bonds and individual shares, you pay income tax at the marginal rate on the income. Income from bonds are known as coupons, income from shares are known as dividends. So you pay at the marginal rate, which should be over 50%. and 33% capital gains tax on the sale of the share or the bond on the secondary market, or if it's a bond at redemption. If you buy a bond at €1 and it's redeemed at €1, there's obviously no gain in capital terms. You would have paid income tax on the dividends or the coupons along the way. If you buy a bond on the secondary market at 90 cent and it's redeemed at €1, you have a 10-cent gain on that as such. As I said, Irish government bonds are exempt from capital gains tax. So then when you go into collective bonds, you pay 41% in income and 41% on gains. So it's quite simple and the same. And you can choose an accumulating share class or a distributing share class. Some people just go for the accumulating share class purely because it just means you don't have to file taxes on the income every year. The same amount just gets rolled up within the fund. With collective bonds, there's 41% exit tax regardless after 8 years or on sale, 41% tax. A type of policy a lot of our clients use, which we like, is an umbrella policy, which is a policy where you're taxed at the umbrella level, okay, the policy level rather than the fund level. So what it means is that you can have a full portfolio of funds and options within the umbrella policy, and there's no tax implications below that. It's only taxed at the policy umbrella level. So it's just very efficient from a filing perspective. Speaking of filing, deposit interest retention tax is taxed at source. Like the bank will withhold that before they pay it back, pay your net interest. Capital gains tax is done on a self-assessment basis. So if you sell shares at a profit, you have to file the tax on it. Income tax is also done on a self-assessment basis. Be mindful that there may be withholding tax withheld by a stockbroker, and you need to get your tax statement to see what was withheld, and your liability will take that into account. For income and gains and collective funds, okay, Irish-based investors is quite simple. The insurance company or the fund manager will withhold the tax at source and file it on your behalf after 8 years. But for offshore funds, it's up to you under self-assessment to do that. And also a small thing, if you're buying offshore funds through a stockbroker, whatever it is, the actual acquisition itself needs to be filed by revenue to tell revenue, I bought a fund in the UK or Luxembourg, whatever it is, and all sorts of details. So again, this isn't the case for pensions or for charities. It's only for personal investments. So just a market update on each. We'll send these slides on afterwards. These are the current deposit rates available from the Irish banks and the post office. As I said, AIB, Bank of Ireland, PTSB. We'll send this on to you afterwards in the slide deck. This is very interesting. This is the German 10-year bond yield over the last 5 years, okay? So what happened is that if you look at the period in 2021, German bond yields were negative. Like what that meant was that for you to buy a 10-year German government bond, you had to pay Germany money. That's because Europe depressed interest rates so much, interest rates actually went negative. They were trying to stimulate the economy so much that they punished people for buying bonds and keeping money on deposit. And since then, we've had inflation, and inflation has led to higher interest rates. So you can see now, what I'm saying is that bonds are now an investable asset class again, because you can get normal yields again on bonds, individual bonds or bond funds. So you can see there was a drop in yields recently, which when you see a yield drop from say 2.8% to less than 2% or whatever it is, that's positive for the capital value of existing bondholders. But equally, things have pulled back a bit in the last couple of months, and that would be a negative for existing bond investors. Again, we'll send this on here, but just to give you an idea here of some of these bonds, okay? So these are Irish government bonds. Let's look, for example, at the 2035 government bond, the third from bottom here. So if you bought that on the secondary market today, you'll get €1 back or €100 back in 2035, so 11 years away. You'd be buying that at a price of about 77 cents. So you're paying 70 cents for it, 77 cents, and you're going to get €1 back in 11 years. The coupon you're getting is 0.4%. That was based on the initial launch price. So the actual yield to maturity on that is 2.83%. That takes into effect 11 years from now at a 0.4% coupon, which is negligible, as you know. So all your return here will be capital uplift, really. The tiny coupon, obviously. So the calculation here is the yield to maturity is what your 77 cents now will grow to, 24 cent up over the next 11 years. So that's just how they're calculated. Again, come back to me if you have any specific questions on how that's calculated and to give you a flavor of those bond yields. This is just equity performance over the last 3 years. Quite volatile. We saw 2022 very negative. These are 6 of the major stock market indices and how they performed over the last 3 years. As I said, we've had a good run throughout 2023 and for much of the first quarter of 2024, a bit of a pullback in the last week or so, week and a half. But overall here, you can see, the Asian markets have underperformed significantly. Germany's actually only been average, and the rest of them, the big winner, over the last 3 years has been the US stock market. So I'm just going to skip through this slide and just conscious of time. And then finally, to speak about our asset allocation principles, okay? So when you're looking at the mix between equities, bonds, and cash and anything, the same principles apply. You have to look at all of your assets collectively. You can't just make an investment decision in isolation. You have to look at the big picture, and clients of ours in Compass Private Wealth will know that we always focus on the top-down holistic view first and foremost. Risk appropriate. So people will get carried away. So stock markets are up, I'm going to put all my money into the US stock market. That's performed well. But you're taking on more risk, for that. So you have to be mindful of that as well, that you need to be spread as much as possible, which brings down to diversification. You need to make sure your portfolio is structured in such a way that it's commensurate with your risk profile, your appetite to risk, and it's diversified so that you're not putting all your eggs into one basket. You need to have transparency. You need to make sure you understand how your capital is allocated between the different buckets. We focus a lot in Compass Private Wealth on reporting, so regular reporting to show you how the performance has and the asset allocation have changed over time. Always have a long-term focus. Okay, with cash, you kind of have a short-term focus because you might need it, but with bonds, in particular equities, always have a long-term view. So if you have capital in equities at the moment, and you say, God, equities have performed so well, but you have to say, well, if you have money in equities, that really is a 10-year plus view, and there will be volatility along the way, but if you have a long-term focus, the chances or the odds are always with you. Make sure your types of securities populate the portfolio are appropriate, that you don't have too many direct stocks because that might be risky, or you have the right type of collective vehicles and structures in place. Always be mindful of fees and taxes, okay? That's always, because they're the 2 things that can drag down a portfolio performance. Pensions and charities don't have to worry about taxes, but other people need to make sure that the fee structure and the tax structure is efficient for them. So the risk will depend on a number of different factors. Many of you have seen this slide before in meetings. And just diversification here. These are the different types of factors for diversification. Why diversify? It's to reduce risk and to smooth out returns over time. So that's it. We're just coming up to a minute to 40 minutes, 39 minutes in. If you want to ask any questions, there is a Q&A tab there. I have 1 or 2 questions that have come in, which I'll answer now. But do put more questions in based on the content of the slides, or any general question on cash or bonds or equities. Question here is, where do I see bank deposit rates going this year? That's a very relevant question at the moment. I see them going down. I think we're at peak deposit rates in Ireland at the moment. I personally can't see any bank increasing interest rates from here. When you see the slides we send on, you'll see the range of deposit options at the moment. They're actually quite attractive in a lot of ways. You can see mortgage rates have started to come down a bit, and usually when banks do that, they'll follow with deposit rates because they can justify reducing deposit rates because they reduce mortgage rates. So I think rates are at peak rates at the moment. So, we are in this fortunate position at the moment where we're getting decent enough fixed term deposit rates, but I can see those term deposit rates coming down. Another question here just on US bonds and the rates on US bonds. So the issue for an Irish investor, similar to what I said about buying, having cash and dollars, the issue with buying US government bonds is that you're taking 100% dollar risk then. A lot more so than investing in the US stock market, because US stock market, the companies you're investing in have operations all over the world. But if you're buying US bonds, you're taking on two things: the actual coupon and the actual bond risk itself, but also the currency risk. So, we'll send out the updated 10-year yield on the US bond after this call to this person who's asked that question. But overall, it just reinforces the merits of going to a bond fund with a professional manager who can kind of manage currency risk by going into a range of different bonds through different structures over different durations. Okay, and I have time for one more question before we finish. The outlook for equity markets this year, again, good question. Look, the way I see it, and clients of mine on the call here will be very familiar with me saying this. If we're the 11th of April today, and if you said, what are the chances of stock markets being up or down by the 31st of December 2024? I would honestly say 50-50. You have 50% chance of being up or down would be the most likely, because we've had a good run to the year. We had a good 2023. So it's toss of a coin, okay? Now, if you ask me that same question, well, how would they be by 31st December 2026? So just under 3 years away. Well, your chances then go from 50-50 up to probably 65, 70% or whatever it is. And then if you ask the same question, what are the chances that equity markets will be above where they are now in 10 years' time? Then you're looking at 90% plus chance. So that shows why it's so important to have a long-term time horizon. Equally, if you said, how will shares in Amazon or CRH or BHP Billiton, how will they be in 10 years' time? You have obviously a higher chance they'll be up than now, but the figures I gave earlier are for indexes. Stock-specific risk is different because you're taking on a specific risk of a company, which is a lot different to what I'm talking about general equity markets, which again reinforce the benefit of investing passively or in a market rather than in individual companies where you're taking on stock-specific risk. So that's it. We're done within just over 40 minutes. Thanks to all of you for joining us today. We'll send out the recording, we'll send out the slides. And if you have any other questions, please do just ping me or any of us here an email, and we'll come back to you as soon as we can. Enjoy the rest of your day, and we'll talk to you soon.